Welcome to the California Small Business Tax and Money Podcast. My name is Megan Robin, and I am a California tax attorney with a Master's of Laws in Taxation. I help small business owners save money on taxes and get their finances on track. Today, I am going to tell you how to manage your own investment portfolio. I get so many questions about this topic. I am not a registered investment advisor, so I don't advise clients on how to allocate their investment portfolios with specific funds and all of that. However, I do inform them of the tax implications of their choices. I think a big reason I get a lot of questions on this topic is because people are overcomplicating it. If you've listened to my podcast or watched any of my videos, you know that I am very wary of investment advisors or financial advisors who act as broker-dealers, meaning that they're selling funds or other investment products. I believe that when an advisor is incentivized to recommend certain funds to you based on the commissions and fees they will receive, they are no longer a fiduciary because they have a major conflict of interest. I am a big believer in handling your investments yourself. However, I know that this can strike fear into the hearts of so many people I talk to. They look at me like I'm crazy. What? I can't handle this myself. I don't know anything about stocks and bonds. Well, you don't need to freak out. I'm going to walk you through exactly what you need to know to move forward right now. I think one of the big reasons that people have so many fears about this topic is because the people selling all of these funds and stocks and bond portfolios are also the ones that are doing all the marketing around it. And so they're sitting you down or in their advertisements are telling you how crazy and complicated it is, how you have all of these different options and you could never figure it out. And then they swoop in and paint themselves as the hero who can save the day and handle it all for you. And you don't have to worry about a thing. The idea that you can't understand this is nonsense. And even bigger, the idea that an investment portfolio should be complicated and include dozens of complicated fancy funds from various different brokerages is complete BS. However, you don't have to take my word for it. As a tax attorney, I consider myself an expert in my own right. However, I know this podcast is new and we're still getting to know each other. So let's go ahead and talk to some billionaires, millionaires, and investing experts and get their opinions. Let's start with Warren Buffett, the famous investor and CEO of Berkshire Hathaway. Buffett is widely regarded as one of the most successful investors in history, with a net worth exceeding $160 billion. He stated, quote, "A very low-cost index is going to beat a majority of the amateur-managed money or professionally managed money," end quote. Let's move next to Peter Lynch, a famous investor who is estimated to be worth around $450 million. He said, quote, "The public would be better off in an index fund," end quote. This one's kind of funny because he made his fortune managing a mutual fund, which is an actively managed fund. But oh well, there it is. Let's move next to millionaire Mark Holbert, who published the Holbert Financial Digest for decades. This publication tracked, analyzed, and rated the real-world performance of Wall Street investments. He said, quote, "You can outperform more than 80% of your fellow investors over the next several decades, simply by investing in an index fund and doing nothing else," end quote. The Economist magazine stated that managed funds, quote, "charge their clients big fees for the privilege of losing their money," end quote. And we'll finish with Tyler Matheson, editor of Money magazine, who stated, quote, "Gunning for average is your best shot at finishing above average. Indexing should form the core of most investors' fund portfolios," end quote. The good news for you is that buying a broad-based index fund is incredibly easy. I am going to walk you through it. Since everyone comes from a very different place regarding what they know and what they don't know about investing, I am going to start with the absolute basics. First, what are stocks? When you buy a stock, you're buying a tiny piece of a company. If the company does well and grows, your piece can grow in value. Let's say that you buy 10% of a company for $10 and the company is worth $100. Then next year, let's say the company grew and it is now worth $200. Well, now the piece you bought is now worth $20 instead of $10. Some companies also pay dividends. Dividends are payments that companies make to their shareholders as a way to share some of the company's ongoing profits. So if you own a stock that pays dividends, you'll get a little bit of money, usually every 3 months or so, just for holding on to that stock. It's kind of like getting a thank you check for being a part owner of the company. Next, let's talk about bonds. What are bonds? Buying a bond means you're loaning money to a company or a government. In return, they pay you interest and then repay the money back to you later. I have a whole nother episode on bonds, so I'm not going to go into too much depth on them here, but if you're curious, go check out that episode. Okay, so what is a fund? When I talk about investment funds, what am I talking about? A fund is like a big basket that holds a lot of different types of investments. So you could have a fund comprised of stocks from several different types of companies. You could have a fund with lots of different kinds of bonds, and even both. You could have a fund that has both stocks and bonds in it. Instead of picking individual companies, you're buying a slice of that basket when you buy into a fund. So instead of just buying $100 worth of Ford stock, you can buy $100 worth of a fund that includes Ford and 100 other companies. There are many different types of funds: mutual funds, index funds, and ETFs. Let's break down these main types. A mutual fund is when a professional manager picks what goes into that basket. You buy shares of the fund, not the individual stocks or bonds. With an index fund, this is a type of mutual fund or ETF that simply copies an entire whole market index, such as the S&P 500. It's passive, meaning there's no manager trying to outsmart the market. The fund is just indexing or copying what a broader market segment is doing. The S&P 500 is a list or an index of about 500 of the largest and most important publicly traded companies in the United States. It represents a wide range of industries, and it's used as a simple way to measure how the overall U.S. stock market is doing. So when people say the market is up or the market is down, they're usually often talking about the S&P 500 because it covers around 80% of the total value of all U.S. stocks and gives a good snapshot of the health of the economy and investor confidence. Let's talk about a few more that you might have heard about. There's also the Dow Jones Industrial Average. Sometimes people just call this the Dow. This tracks 30 of the largest and most established U.S. companies, the who's who of American business. It's one of the oldest and most famous indexes, and people often look at it as a quick read on the economy's health. To give you an example, some of the well-known companies that are part of the Dow include Apple, Microsoft, Coca-Cola, McDonald's, Johnson & Johnson, Visa, Boeing, Walmart, Disney, that sort of thing. Next, let's talk about the NASDAQ. This includes more than 2,500 companies listed on the NASDAQ stock exchange, with a heavy focus on technology and growth companies. When you hear about the tech sector booming or slumping, this index is usually what's in the spotlight. Next, we can talk about the Russell 2000. This tracks 2,000 of small publicly traded U.S. companies, giving investors a sense of how small businesses are doing compared to the giants in the S&P 500 or the Dow. Then there is the Bloomberg Barclays U.S. Aggregate Bond Index, often referred to as the AG, the broad index that measures the performance of U.S. investment-grade bonds. The investment-grade bond market refers to bonds issued by governments or companies that are rated by credit agencies as having a relatively low risk of default. So no junk bonds here. It's the main benchmark for how the overall U.S. bond market is performing. So when you buy an index fund, you are usually tracking one of these different indexes that I just talked about: the S&P 500, the Dow, the NASDAQ, the Russell, or the AG. All right, let's talk about another kind of fund. Let's talk about a specific type of fund called an ETF, or an exchange-traded fund. The main difference between ETFs and index funds is that ETFs can be traded throughout the day like stocks, while index funds can be bought and sold only for the price set at the end of the trading day. Most ETFs are designed to track an index, like the S&P 500 or the Dow. ETFs are popular because they usually have low fees, they're easy to buy and sell, even if you are only starting with a little bit of money. So now that you know about some of the different types of funds that you can buy, how do you analyze the different funds? How do you choose which one is right for you? Well, there are a few things you need to know. The number one thing that I look at first when analyzing an investment fund is the expense ratio. Every fund charges an expense ratio. This ratio is the percentage of your money taken out of your account each year to cover the fund's costs. The lower, the better. For index funds and ETFs, look for an expense ratio under 0.5%. The best ones are even lower, like 0.03% to 0.3%. If you see anything over 1%, that's a sure sign that this is an actively managed fund. And we already talked about how these often underperform and how these fees erode your returns over time. Once I have decided that a fund that I am looking at has a good expense ratio, I will look at the prospectus. A fund prospectus is a document that tells you everything about a fund: what it invests in, how risky it is, how much it costs, and what the fund's goals are. Before buying a fund, skim the summary, check the risk factors, look at the fees, and make sure the fund's goals match yours. Next, how do you buy stocks, bonds, and funds? There are two ways: brokerages and advisors. My favorite way to move forward is to use a discount brokerage. These are online brokerage platforms like Vanguard, Fidelity, Schwab, where you can buy and sell investments yourself, usually with very low or no fees. You are in the driver's seat. It's easy to do. Just get on their website, whatever discount brokerage you choose, and follow the prompts. The other way to buy investments is through a financial advisor. They do the work for you, but they charge higher fees, sometimes as a percentage of your investments or as commissions on what you buy. The next question I get a lot is how to allocate your portfolio. This is a fancy way of saying, how do I divide up my money between stocks and bonds and between the different funds I'm choosing? Some people keep it very simple. They do a 60-40 or 70-30 split where they would have 70% of their investments in stocks, tracking a index fund like a total market index fund or S&P 500 index fund, and then 30% of their portfolio tracking a bond fund or directly in actual bonds. You can do something as simple as that and be done. There are a million different ways that you can allocate your portfolio. If you want to keep it simple, some people even do target date retirement funds so that the portfolio is being shifted for them, and the choice about how many stocks and how many bonds or what is being invested in is handled for them. That's totally fine. I do see that sometimes these target date funds have higher expense ratios because they're managed, but if you are just really hands-off, there's absolutely nothing wrong with these. Some people like to play around with it a little bit. They'll add things like funds that include gold or natural resources or commodities. Some people even do crypto. The thing is that no one has a crystal ball. So there's no perfect portfolio, no matter what some investment sales guy will tell you. Just think of your portfolio as a pizza. You get to decide how many slices go towards stocks or bonds or other things. There are also a lot of really great ideas online and a lot of portfolios that people imitate. A lot of people will see what the experts are doing and mirror their portfolio to look like the experts. So a popular one, for example, is the Swensen portfolio. It was named after the guy who managed the Yale portfolio for years. You can look up that one if you're interested. There's a ton. I'm not endorsing any specific one because, as I said before, no one has a crystal ball. No one knows if their portfolio allocation will be perfect, especially now in these uncertain times. A lot of people get overwhelmed at this point, and then they want to just hand it all over to the financial advisor or investment advisor. But the average assets under management fee, AUM fee, that most advisors charge is around 1.5%. So if you have a $1 million portfolio, that means you are paying $15,000 a year to the investment advisor to handle it for you. For some of you, that may be worth it. However, I want you to think about it this way. You can make $14,000 worth of mistakes every year in your portfolio and still be ahead of where you would have been if you hired an investment advisor to do your portfolio for you. And if you're just doing basic index fund tracking, it's kind of difficult to make $14,000 worth of mistakes. I don't know. Maybe you got wild and woolly and decided to put 14 grand in crypto and lost it all. But even still, say you decide to do that, you are still in the same place you would have been if you hired that advisor. So stop stressing out. Keep your portfolio boring and simple and get it done. A term you will hear a lot of investment advisors talk about is portfolio rebalancing. What does this mean? Well, over time, some of your investments will grow faster than others, meaning that the pieces of your pie that you set up, maybe you did the 60-40 split, all of a sudden at the end of the year, you might find that you actually have 80-20 now. Rebalancing just means adjusting your portfolio back to how you wanted it, back to your target mix. Most people do this once a year, or if they're really gung-ho, they can do it every quarter. Some people put percentage targets, so they rebalance whenever a portion of their portfolio drifts more than 5% of what their target amount is. But you don't have to get that specific. However, I want to pause here and say that you do need to be careful when you are buying and selling bonds and stocks and funds outside of retirement accounts, because this can trigger taxes. So come talk to me before you make any major moves. This is a huge issue that I see with brokerage advisors, financial advisors, investment advisors, is that they will be trading willy-nilly, trying to rebalance portfolios, or a lot of times they trade because they get trading fees and commissions when they trade. They tell the clients that this is a good idea. However, then it comes on my desk and I see that this is actually a horrible idea because it's triggering all kinds of tax implications for the client. This is something that I work with clients on and I flag to make sure that your investment advisor is not going wild with trades, trying to earn themselves a little bit more money and leaving you with a huge tax bill. Investing is a long-term game. Here's the golden rule. Only invest money that you won't need for at least 10 years. Why? Because the market goes up and down, but over the long run, it does tend to go up, at least historically. There's no promises here. This is the stock market, but historically, it does tend to go up. The best investors are not glued to their screens, trading back and forth all day long, or panicking during worrisome news cycles. They pick a solid, diversified portfolio, automate their contributions, and let time do the work. You don't need a financial advisor to get started. With a little research, a low-cost brokerage account, and a long-term mindset, you can build wealth on your own. Remember, diversify, keep fees low, rebalance occasionally, and then sit back and let your money grow. That's it for today's episode. Until next time, happy investing! This content is for informational purposes only and does not constitute legal, tax, financial, or investment advice.